Hey everyone, Tom Gentile here. Welcome to Patterns and Profits Podcast. This is for week ending August 16th, 2024. Today I want to talk about what you can find everywhere and what you can find only here. Okay? Because, yes, I want to talk a little bit about both so that you can distinguish the two. And, we're coming into the middle of August right now. And I got to tell you, the first thing I see that you can find everywhere is a chart of the S&P 500. Interesting that it took 2 days to drop from 550 down to, let's call it 510. 40-point drop in about 2 trading days. And 1, 2, 3, 4, 5, 6, 7, 8 days later, we're back to 550. I did not expect that. Something has happened that I didn't expect. So guess what? The 580 target that we had back a month ago, that's back in play, right? Back in play. The reports we've gotten have been very mixed signals for the market. So you go back and you look at, for instance, the labor report. So let's talk about the labor report for a little bit. Labor report suggested that inflation had dropped to its lowest level in 3 years when you look at an annual basis. And what that did was that set up the Fed to cut interest rates, okay? Which is obviously going to be good news for a lot of folks, going to take pressure off the economy a bit. But that report that came out back on the first Friday of August, that was probably the clearest indication that we've gotten yet that inflation it's not there yet, but it is heading back to normal levels. If you remember, we had 40-year highs. And are we going back to normal levels? Yeah, it looks like that's happening. Are we going to get there without a recession? Well, to me, I think that depends on who you are, okay? So think about this. Central banks, they're ready to cut. I mean, cutting is going to do what? It's going to allow businesses to get loans. It's going to allow households to jump back on and start looking at mortgages, maybe auto loans. Maybe they're going to try to grow their business. I mean, for the last couple of years, it's been hard. It's been hard. We've had high prices. I mean, think about this. 2 years ago, high gas prices, high food prices. Everything ran up like crazy. And then what did the Fed have to do? Raise. So we were in a period where prices were high and interest rates were high. And interest rates are still high, but prices have come down, right? And when you look at the inflation rate, and what happened at the beginning of the month, it's pretty much in line with what the Fed was expecting. But, I was looking at the inflation we had. Check this out. I mean, our inflation was around 9% as we were coming into 2022. The only times that, I can't even remember. The last time that we were this high back in 2022, you had to go back to 1980. Prior to 1980, when we had those 14% inflations, and mid-70s, we were around 12%. I mean, guys, mid-70s, I was 10 years old. 1980, I was 15. So honestly, I don't remember inflation. For me to remember, I have to go back and look at pictures. And even then, I can't remember this stuff. But I remember what happened a couple of years ago, and a lot of people remember it more than me. So, you've got that. What was the biggest inflation indicator in the last 2 years? I know what it was. At least I believe I know what it was. Housing. We saw house prices literally double between 2020 and 2022. Prior to COVID, I don't know what the average house price was. I know what the average house price was in the community that I live in, which is the Sarasota Bradenton area. I think where our average house prices for a gated community was probably around, $500,000-$600,000 for a big house. Those doubled. Those numbers doubled. And they are starting to creep down. So, for instance, rent costs, they've been cooling off for a while. Florida, it's got its own problems. I mean, you look at what's going on here in this state. We've got kind of a perfect storm brewing, which is pushing house prices down. A lot of houses in several communities have for sale signs on them, and they're not selling as quick as they were. Right? Average homes is on the market much longer than it was. And that's because a lot of these folks they aren't buying into the fact that they're going to have to really make a significant cut on their home price if they're going to sell it. Now, there's two other things going on. Number one, if you're in a condo down here in Florida, depending on where your condo is, you have to deal with possibly assessments. One-time assessments. They call them one-time assessments, but they've been happening more and more. And that's where the condo associations take a look at its balance. And they're realizing that inflation is costing more to maintain condos, so to maintain the maintenance on the condos, painting on them, HVAC, plumbing, electrical, and then there's the lawn maintenance, landscaping, etc. All this stuff has doubled in value as well, more than doubled in value. So there's folks going into condos that moved into condos 2 years ago and, had budgeted them out correctly. And now they got to sell. And the reason they got to sell is because the condo price or the HOA fee, right? That homeowners association fee, if you live in a condo or even in gated communities, has in a lot of cases doubled in value. I tell you what else has gone up. Maybe it's gone up 50%. You know what else has gone up, which is bringing up the other 50%? Insurance, most notably flood insurance. So we've had a series of tropical storms and hurricanes. More have come through this particular area, and probably in Florida as a whole, than I've seen. In me living here the last 15 years, I've never seen this before. In the last couple of years, let's just take in the case in point, the last tropical storm that rolled through here, which was Debbie, just a week, 2 weeks ago. And, there wasn't a lot of wind, but I've never seen the flooding like we've had before. I think I was joking last week when I said my property, that I had almost a 360-degree waterfront house because water was coming up on literally all sides. I think 3 of the 4 sides of my house had water in them. They receded rather quickly. What we found out was that a dam had to be released. They had to release the water out of this dam because it was rising so fast that it was going to cause the dam to break. So they made an emergency decision to release that, and it affected a lot of folks around where I live. Where I'm going with this is flood insurance is getting very expensive. Auto insurance getting very expensive in Florida. I've seen my auto insurance rates go up like crazy. You probably listen to this podcast and say, what's Tom complaining about? I'm just setting in motion for you the events that are causing people who are on budgets to have to make decisions. And some of the decisions they're making are self-insure. Rolling the dice, where they have to pay for their own problems if they come up. Now, you can't do that with HOAs. You either pay or they put a lien on your house. But you could choose to self-insure. I think that that has its own risks and rewards. Energy costs high, but a lot of the stuff's going down. Some of the stuff is going down. Energy costs are declining. It looks like, when you take a look at things like used cars, and then you look at things like apparel and you look at things like airline costs, they're dropping a little bit here when you look at what happened at the beginning of summer to now. So that's all well and good. And I think that's, you're seeing inflation starting to come down in most areas. That's going to cause the Fed to cut rates, maybe even a bit more than our expectation, which is why a big reason why we're seeing the market snap back. And it's snapping back. I'm not going to say as fast, but it's almost as fast as it dropped. It's been on the rise again. All right. The other big piece of news that happened this week, retail sales. Take a look at what happened to Walmart. Take a look at what happened to Target. They got the retail sales figures out. And, you got to imagine a company like Walmart is going to thrive when it comes to their numbers, clocking in higher than expected because more people are going back to Walmart to buy goods and services. That's why on Wednesday of this week, Walmart was trading at around $68 a share. And on Thursday, it popped to 74. It jumped to new highs, new year-to-date highs in one day. All right. What about Target? TGT. All right. So whatever happens to Walmart, Target's gonna react literally the same way. Target and Walmart, if you were to take a look at those two stocks, one's in an uptrend, we'll call that one Walmart, and one is in a downtrend, we'll call that Target. Now, Target's come way off. I mean, it's come way back from the lows that it had a couple of years ago. But I'm talking about since April. April, the overall market pulled back, and then it snapped to new highs. In April, Target pulled back from about $180 a share down to around $130. Now, they popped as well. They popped from about 135 to 142. But we're talking about two different companies here. Walmart, Target, you might say, one's in the blue building and one's in the red building. That might be, there's the contrast there. They might be big box stores, but just as the colors of their buildings are different, just as the color of their branding is different, their stock prices are different and their trends are different as well. Walmart beat its quarterly earnings, beat its revenue expectations. It raised its full year outlook too. So, they're a little more cautious of what's going to happen for the second half of the year because, you got to think like Walmart that as rates come down, the only thing that goes up when rates come down is the stock market because it's always ahead of every what's going on in the economy. The economy is softening, and we're going to need a few rate cuts before the economy stops softening. And I think that's what Walmart's trying to tell us. Now, there was another piece of news that came out this week too. Again, stuff you can get everywhere. And that was that the poaching that was going on over at Starbucks. So apparently Starbucks offered more than a hot latte to Brian Niccol because they convinced him with about $10 million in cash and I think about $75 million in equity for him to jump Chipotle and come on over to Starbucks as the CEO. So, he's got a nice little contract, guys. $1.6 million a year. He gets to earn, I think, over $7 million more with earnouts. And his job is to turn around what's going on at Starbucks. We'll see whether or not that happens. But, you take a look at SBUX, SBUX. And you can get an idea earlier this week what happened. We're talking about, if you look at Starbucks, since 2024, Starbucks has actually just been dropping. It was $100 coming into December, dropped all the way down to just above 70, and it kind of double bottomed in May and then again in July. As soon as they made that announcement, that stock went from about $76 a share to $95, just like that. Now, I want you to pay attention to two numbers. This is something that you're not going to hear from everyone. Hear from everyone, Brian Niccol jumps off of the Chipotle train and jumps onto the Starbucks train. Yeah, you'll hear that from everybody. You know what you're going to hear from me? I want you to pay attention to 90 and 90, we'll call it 96. Yeah, 90 and 96. Those are two numbers for the price of Starbucks that I want you to pay very careful attention to. Because if Starbucks jumps above 96, there is a better than not percentage, a pattern that will make a run up to the low 100s. But if Starbucks, the stock, closes below 90, then expect this to go back down into the mid 80s. The reason I say that is because if you take a look at the gap, all right, when you're done, or if you're listening to me in front of a computer, go take a look at the volume that came into that stock when that news announcement came out. Everybody started buying. And was it an exhaustion buy, or is it set up for something more? To me, it looks like a setup, but we're just not sure which way it's going to go. And I wouldn't want to buy it or sell it at current price, but I like it if it gets above 95, 96. I don't like it if it gets below 90 as a short-term trader. That's called momentum. And what we're doing is we're looking at all that volume and whether it's going to be, buyer's remorse if it goes down, or it's going to be buyer's jump on board if it goes up. Let the price dictate what we want to do. All right. Hey, you want something else that nobody hears about? All right. Let's talk about something else that nobody hears about. And that is what I like to call, let's take a look. Let me set you up with what we did last week. So last week I talked about, or was it a week before? Maybe it was last week. We talked about 3 or 4 stocks that were hitting 52-week highs. And last week I said, these are defensive stocks, but they're going up as the market's going down. You remember that conversation? Let's bring those up again. T-Mobile was one I was talking about. All right. Symbol was TMUS. And I said last week that T-Mobile, which was trading around $186 a share, I said this one was very close to 52-week highs. And keep an eye on it because it seems to be doing very well, despite the fact that the market wasn't doing so well. All right. Well, what's it done this week? Well, not only has it gone above 186, but it actually went up to, I think, closer to 196. So that's had about a 10-point move just in the last week. And that's with the bounce in the market. So that was a pretty realistic move and a low risk move. What else did we talk about? Did I mention Raytheon? I don't know. RTX? That was also on the list. And Raytheon was trading at $115 at the time. Raytheon's at $118. So it's gone up a little bit. I know I mentioned 3M as a stock that was trading near its 52-week highs. And that stock last week was at 124. Right now it's 127. So it's up a little. How about Coca-Cola? The ultimate defensive play if the market moves lower. Well, the market did turn around, move higher. You know what? It's trading literally where it was last week. Last week at $68.10. This week I've got it at $68.70. And then finally, here's another one. The last of the series of stocks that were hitting 52-week highs as the market was pulling back, and that was Procter & Gamble. 168 was the price last week, 167.27. Okay, so it's off a little bit for the price this week, but hey, 4 out of 5, not bad. Even with the snapback in the market, you would expect that list to pull back if the market moved higher. And that didn't happen. Those boring stocks during chaos became good even when the chaos had a bounce. So is there chaos in the markets? There could be. I mean, I'm looking at my accounts, and I have my long-term account, and it pretty much moved in the last since August 8th. It's moved slightly higher. And in my medium term account, I mean, it looks like we're doing push-ups. Up, that was August 8th. Down, August 11th. Up, August 13th. Down, August 15th. Up, it just keeps going up. I mean, I feel like I'm doing lifting here with all of the volatility going on in the market. And my medium term is a mix of different things, right? And then I look at the crypto account. It's the same thing. Up, down, up, down, up, down. I mean, I had up, down, up, down, up, down, and we're not even at the end of the week yet as I'm recording this, and we're back on the upswing again. So there's been a lot of volatility that's been happening in these markets. Now, I want to finish this week's podcast talking about cheap, cheap, cheap. And when I say cheap, 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 now, it's funny because I'll tell you a little story. So many, many years ago, I was involved with a small company which was off of the American Stock Exchange, and it was my job to help we were in the process of creating one of the very first wireless trading devices. And I know some of you listening to this podcast probably don't know when there wasn't a wireless trading device. But then there are several of you listening to my podcast know exactly what I'm talking about. You know that before wireless phones, remember when you used to see the snapshots with the floor of the stock exchanges when people were wrapped around the phone cords, they were with all the orders coming and going. And then the invention of the cell phone, McCaw Cellular, that's the first one I remember. And we used to carry around these big bricks. I think I got mine from Radio Shack. This big, I mean, it looked like something the military was using. We were looking for Charlie, only we were looking for Charlie in New York, not Charlie in a war-torn country. But anyway, yeah, so I was kind of tasked with some others to try to come up with, and we successfully created one of the first wireless trading devices. You know where we screwed up? We used what was called packet technology. It was technology that was developed by the Swiss Army. And we brought that in, and it used radio signals. And anyway, long story short, we ended up selling it to Bell South, and they quickly shelved our product. They shelved it for something else called the internet. Boy, they were right. They were spot on right. I bring that up because I remember being in a meeting where we were showing this to Schwab, and we were showing this to Lynn Waldock, and we were showing this to Epstein and Company, and Ira Epstein. This was a commodities company. Looked at this, and he liked it, and he said, "What do you retail this for?" And I said, I'm trying to remember what I said, but it was something like we were going to charge $100 or $200 a month because we were looking at this being a very high-end product. And he said, absolutely not. You want to sell it cheap, cheap, cheap. And I just remember going out of the meeting, me and the guys with the company that we were working with at the time, were just laughing about how he said cheap, cheap, cheap. And this was, oh my God, more than half my life ago, and I still remember it. I'm still laughing about it. So why do I bring up cheap, cheap, cheap? Because that's what we want to do as option traders. We want to buy calls and we want to buy puts, not when they're expensive, but when they're cheap, cheap, cheap. So how do you know what cheap is? Is cheap the price of an option? You might think that, because early in my option days, I used to think, well, why buy a call option for $500 when I could buy a call option for $200? And I used to think it was what you paid for the call option, not what it was really worth when you looked back over a period of time on near money call options and near money put options on that underlying instrument. And so what I'm talking about, folks, is that there are times when a company like Cisco or a company like Walmart, where their prices for their options are more expensive in certain times and they are cheaper in other times. And what I'm referring to is the time value around an option. So we know that out of the money options have nothing but time. We know that in the money options have real value, and they also might have some time as well. But the best way to gauge whether an option price is cheap or expensive is by looking at its at the money options. It's at the money options, in most cases, have the most volume. Therefore, that bid and offer price is set amongst a lot of efficiency. And therefore, we can properly gauge whether it's cheap or expensive. I want you to think about temperature for a moment. I use this analogy a lot. Think about Florida. All right. What's the coldest on average here in the state of Florida? Let's call it 30. What's the hottest on average here in Florida? Let's call it 100. So if the low for the year is 30 and the high for the year is 100 in degrees, and today it's 95 degrees, I think it's pretty safe to say that we're closer to the high than we are the low. All right. That's what we look at. And so, I remember when we think about cheap, I'm looking to buy option premium. If I want to be an option buyer, I want to buy it when we're closer to the low of the range. So let's talk about 3 stocks that are half off right now in terms of option premium. First one I want to talk about is Carvana, CVNA. So Carvana, earlier this year, and I'm going back and looking at the April pullbacks. This stock in the last April, May, June, July, August, last 5 months, has a price range. It was at $70 back in April. This thing's trading north of 140 today. So the price, the cost, or the cost of the stock is now double what it was. But as option traders, you might think, well, the 70 call, the 140 call, Tom, is going to be more expensive than the 70 call. Yeah, it might be. But when you look at the premium, you look at the time premiums of what they are before earnings and what they are after earnings, you're going to see something quite a bit different. Let's just talk about what's happened in the last 2 weeks. So 2 weeks ago, Carvana was at $140 a share. Now it's a little bit higher, but the options, all right, the implied volatility on the Carvana options were trading north of 115. That was 2 weeks ago. Today, they're below 60. So guess what? Time premium, half off today on Carvana. Now, if you like Carvana, then you might be interested in buying call options on it. If you think Carvana is going to snap back, you might be interested in buying puts. I'm just telling you, the options are half off. Number 2 on the half off sale, Roblox, RBLX. Now, Roblox saw a low in May of around $30, and that's probably thanks in part to the fact that they had, even though they had an earnings report that beat, their guidance was terrible, and the stock went from 40 to 30 post-Hatus. And so since then, though, it's come back. It came back up to 40. And then they just had their earnings announcement at the beginning of the month. Stock dropped back down to mid-30s, but it's since climbed back. Right now, the stock's trading around, let's call it 39.5. But guess what the options have done since the beginning of the month? They have dropped by more than half on their time value. In fact, they're as low as I've seen them all year long. Roblox options, cheap. If you like Roblox as a company, you might be interested in the calls. If you think it's going to come back down, though, you might be interested in the puts. And finally, the third stock I want to talk about on our cheap, half off sale is Shopify. Symbol is SHOP. So Shopify is a bit of a different animal. This thing, up until a week or so ago, looked like it was in a downtrend. We saw lower highs and lower lows. Stock went from, let's call it just below 80. This was back in April, down to around the high 50s in May. It ran back up to 70 by July, but then the month of July saw it go from $70 a share down to below 50. Then it jumped on its earnings right back to 70, currently trading around 74. But it's the options that have me excited, because the options have gone, the implied volatility levels have gone from an 85 down to below 35 in just the past week and a half. So options on Shopify, cheap, cheap, cheap relative to where they've been. Again, if you love Shopify, you might be interested in the calls. If you hate Shopify, you might be interested in the puts. Both calls and puts, much cheaper on this stock and these three stocks than they were earlier in the month. So that's the piece that I wanted to share with you here as we go out. By the way, is there anything that Carvana, Roblox, and Shopify have in common other than the fact that they have cheap options? I'll tell you what else they have in common. They're pretty close to their highs year to date, if that has anything to do with your research. If you love these stocks, if you hate them, it's your job to decide whether you like them to the long side or the short side. I'm just telling you that they're options. If you're an option trader, this is the time to be looking at buying options on these three stocks, regardless of whether you're bullish or bearish. That is it for me for the week. I am signing off. Have a great weekend, folks. I will see you again here next week. Bye now.